Made several videos thus far covering the Celsius bankruptcy and the associated tax implications and how you can calculate the tax impact for the 2024 distributions, as well as the distributions coming in the future. We've mostly focused on the earned distributions because this is where the majority of creditors are, but there have been people that have been asking us to cover loans and how to handle the loans and those tax implications. So today we're going to be whiteboarding out an example of exactly how to handle the tax impact for loans, and then how to do that calculation yourself. So stay tuned. So before we get into the calculation behind me, I just want to talk a little bit about what happened and how the loan is being recognized. So essentially, in short, you submitted either Ethereum or Bitcoin as collateral, and then you received a loan, most likely in USDC. And so when the bankruptcy happened, essentially what Celsius did was a portion of your collateral. They're like, hey, we'll take a portion of the collateral that we already have and we'll just give you the loan. So instead of us having to repay the loan and then receive back our collateral, what they did was they said, hey, keep what you borrowed, let's say that USDC, and then a portion of the collateral that you gave to us, that will be seen as like a trade for that collateral, and then the remaining portion of the collateral that was not used in that exchange, that will then flow through to your regular claim and will be included in the distributions that are that were made in 2024. So again, just to recap, we submitted Bitcoin or Ethereum as collateral. We received like USDC as a loan, and then when they went bankrupt, instead of having to pay back that loan and then receiving back our collateral, what they did was they said, hey, keep that USDC. We'll take a portion of your collateral as payment for that USDC essentially, and then the rest of the collateral that is still with us will be part of your claim and will flow through to the future distributions that you'll get. So that's what happened. And then how do we recognize that from a tax perspective? Well, that's what we have behind me. So essentially, you have Bitcoin and ETH that you could have submitted as collateral. And so we have the petition prices and the effective date prices. I'll give you guys a hint. This is a lot easier to do in Excel than on a whiteboard. So I strongly recommend not recreating an Excel sheet on a whiteboard, but doing it in Excel yourself. But essentially, these are fixed. So these are the petition and effective date prices for Bitcoin and Ethereum. Down here, this is like the formula, I guess. So we're only going to be focusing on a Bitcoin example. So I'm just using this section to show you the formula that is written out in each of these, to determine what goes in each of these. So let's take the scenario that we borrowed 11,000 USDC. Okay. And the collateral that we submitted was Bitcoin. And based on just the way things shook out, in this specific loan, we submitted 1.034369 Bitcoin. Okay, so again, what happened was we gave up and submitted as collateral 1.03 Bitcoin, and we got back 11,000 USDC. Now again, they didn't make us pay back that 11,000 USDC and then give us the collateral back. They basically kept this, told us we could keep the 11,000 USDC, and then some portion of this was then flowed through to our claim. So this is what we calculate down below. So using this formula, so 1 times 4 times 1.05, so the petition price times the collateral quantity times 1.05 is going to get us this value. Now, if you recall from our previous videos, what is this 5% markup? This is unless you specifically opted out of the class settlement claim, then you get this 5% markup. If you specifically opted out of the class settlement claim, you would not get the 5% markup. But for anyone that doesn't know what I'm talking about, this applies to you. It's only if you specifically opted out. So following this formula here, it's going to be the 19,881 times, I'm not going to write the whole thing out. I don't have enough room. But basically, it's this number multiplied by this number times 1.05. And that gets us to 21,593. Do the same for down here, following this formula, it's basically just the same thing except using the effective date price. Okay, so this gets us the petition date value of the collateral plus the effective date value of the collateral. And then now the real question is, this is like really the only box we care about here, is the collateral that was liquidated for the principal. So like I said, a portion of our collateral right here was going to be liquidated in exchange for us getting to keep the principal. The remaining portion flows through to the earn claim. So following this formula, we take the principal, $11,000, divided by the petition date value of the collateral, $21,000, and then we multiply that by the total amount of collateral. So again, just follow the formula here, 3 divided by 5, so principal divided by the petition date value of the collateral times the total quantity, and that gets us to 0.526944846. And then the remaining amount, so whatever was not used here, is just what's included in your earn claim. So 1.03 minus what we just calculated here is going to be what goes to the earn claim. Okay. And that's pretty much it. So what does this mean? Well, all this means is this amount of your collateral should be shown as a trade for the 11,000 in principal. So you'll show that on your 8949. Whatever cost basis you had on this principal, you'll have a gain or loss depending on the cost basis you had here for the principal. The remainder of this collateral that we had submitted just flows through to your earn claim. So if you've watched our other videos, or if you haven't done so yet, go watch those. This is essentially just included in your balance, for your claim. And then whatever cost basis on this is included, there as well. And then it just goes through that same calculation that we've already done. And that's how you determine how much cost basis to allocate to the new Bitcoin, the new Ethereum, the stock, the liquid asset recovery, all that. So again, here, what we just calculated in this box, this much Bitcoin and its associated cost basis is liquidated for this principal and the fair value. So you'll have a gain or loss depending on if you had low cost basis or high cost basis for that that Bitcoin collateral. The remaining amount just flows straight on through to your earn claim, where you can pick it up in our other video, and we will basically it just flows through, and the distributions are automatically included. So nothing else to do. It's not too complicated. You'll do this for both Bitcoin and ETH loans. I just showed a Bitcoin example, and then here are the formulas if you go ahead and plug this into Excel. Thank you so much. And that's it. So thank you for watching. If you don't use a software, I highly, highly recommend using a software for your crypto tax. It's pretty much impossible, in my opinion, without using software. We use Coinly here, but there's plenty of options. If you guys want to link to Coinly, we'll link that down below. And if you want more professional help, that's not just hiring a full-on CPA, we have put together a step-by-step course guide that goes over exactly how to get all your numbers from Coinly, pull them into Excel. We show you how to do the full calculation in Excel and then go back to Coinly and reapply it so that the calculation is done correctly and it's compliant, but it's also optimized for you. We go over loans and all that. So if you want to check that out, we'll link that below as well. Otherwise, for more free content, make sure to subscribe. Thank you so much.